Hi, Nathan Boyd, Homestead Financial Mortgage. We're going to talk Fed. Today, the Fed's increased the interest rates again. So we're going to talk about what they increased, how much they increased it, why they increased it, and how that's going to impact you. So it was a significant day for a couple of reasons. You know that they're trying to control inflation, and that's their job. So what they're trying to do is slow down the economy, and how they do that is by raising interest rates, right? To kind of stymie the growth, limit the spending of our economy. But before we get into that, let's rewind the tape just a little bit. Let's go back during the pandemic, understand what they did. So during the pandemic, they needed to support our economy, and they did two things. Number one, they took short-term rates and lowered that to zero, right, to support our economy. What short-term debt is, that's how banks borrow with the Federal Reserve. That would be lines of credit, credit cards, auto loans, things like that that consumers carry. They lowered all that short-term adjustable debt. So number two, also during the pandemic, they bought mortgage-backed securities. In particular, that's how they impacted long-term debt. And what long-term debt is your mortgage. So when we originate loans, we package them all together. We sell them off to Wall Street as securities. So that's long-term debt. So what happens if there's a lot of buyers of that debt, rates go low, right? If there's not a lot of buyers, the yields move up and the rates go higher. So the Feds jumped on that. They bought everything they could to keep rates low. But now here's a second problem we're going to have. Now, not only did they increase rates 3/4 of a point, they're now unloading all that debt they bought during the pandemic. They're not doing it all at once. They're doing it strategically over time. But that's not only going to impact your short-term debt, which again, lines of credit, credit cards, auto loans. We need to protect ourselves, and I'll talk about that in a second. But number two, if you're looking to get new debt, let's say a purchase for an example. Now that they're unloading what's called their balance sheet, they're pushing that debt they bought during the pandemic back into the market. So long story short, that's going to push long-term mortgages, specifically the 30-year fixed, higher. That's a problem. Let's look at the short-term debt, how you can protect yourself. Number one, you have credit cards. You have all this equity. We need to take that short-term debt that's now going up, that's non-tax deductible, and turn it into good debt. Let's capitalize on the equity you have. Yes, they probably gave you a great rate during the pandemic, but if we rerun the numbers and you're paying double digits, let's say 18 to 20% on credit card debt, let's move it into a long-term debt. Let's say 5.5% on a 30-year fixed. Your monthly savings are going to be significant. And what I want to show you, you have to see the numbers. That's why I put the total cost analysis down below. I can show you an example of how a client turns short-term adjustable, non-tax deductible debt into tax-deductible good mortgage debt. Number two, if you have that line of credit, you're being impacted. Back in March, they raised 1/4, and you probably didn't notice that, but today, they've raised it now almost 3.5 points up. So that 4% line of credit is now 7 to 7.5%. If the Fed can't control inflation, we could see another raise, and you could be at, heck, 9%. So that's a significant impact when you increase the 3 to 3.5% interest on you're paying on that. So we need to now take that equity. Let's combine the first and large line of credit that you did, a remodel or restructure with. Let's pay that off and turn it into good debt, long term. Number three, if you're looking to acquire new debt, what I mean by that is going out to the market to purchase a home. That's going to be a problem, especially as they're unwinding their balance sheet. They're really going to significantly push up interest rates. So here's a strategy I need to teach you if you're getting into, say, a new home. I need to teach you what's called a seller buy down. When rates are up, high, right? Okay, so we use that to negotiate with the seller to bring rates down to bring the affordability back down, excuse me. We have a huge affordability issue right now, So everyone's being impacted. I'm sure you're realizing that as you're looking at houses. The seller buy down is going to be a valuable tool for you to get into the marketplace. You can create some affordability. I also put that TCA down below. I have a couple of TCAs to show you, like how to pay off credit cards and how to use that seller buy down to get back into the market. So let's do this. My contact information is all over this site, so you can reach out to me, text, email, whatever you need to do. Let's sit down and analyze what area you're concerned with for those adjustable rates, credit cards, equity lines, or you're purchasing a new home. We'll talk about the seller buy down and we'll go from there. All right, appreciate you watching this video. Thanks, take care.